Hello, and welcome to another episode of Trade Stylist, the place where we try to craft your trade. This is the first week of February, and the episode goes out on 3rd of February 2024. We start with our disclaimers that, first of all views are my personal views, and of course, the risk disclaimer that every investment is subject to market risk, and any data or trading advice should not be considered as market advice, and that you do need to make your own decisions before you place a trade. That being said, hello once again. I am Debijyoti, better known as DJ. I'm here to help you craft your trade, and you can find me at the rate Trade Stylist at YouTube, X, and on Instagram. As I always say, may the trading gods be always with us. And we move from there to the market update, where we looked at how the markets have performed over the week. So first of all, Robusta down a bit, same with Arabica, roughly 1.2, 1.3%. But cocoa continues its winning streak. Cocoa London up by almost 8%, and Cocoa US up by 7.1%. And Cocoa US crosses $5,000 for the first time in 46 years. Orange juice up strongly over last week at 17.3%, while cotton and sugar also up by 3.2% and 0.5%. Sugar has reclaimed its positive territory, and we seem to be looking at a great setup pretty soon. On the other hand, we have the grains. Wheat almost slightly positive. It was a 601.5. Last week it closed at 601.75 this week. Corn down by 0.8%. Soybean significantly down, as I've been expecting for some time. It breached the 1200 mark and it's down to 1188. We expect it to be probably bearish continuing. Soybean oil strongly down at 4.7%, but soybean meal made a recovery at 2.3% and at 356.9 that week. And YTD 2024, we can look all the soft still holding positive. Cocoa, of course, the highest mover at almost 100% between the two. Robusta faring far better than Arabica at 58 versus 9.33%. And then sugar and cotton bringing up the bottom side at 11.03 and 2.13%. Corn, the biggest loser till now in grains at 34.94%, but overall the grains market has been decimated by at least 22, 23, 24%. This definitely has had an impact on inflation, as we will see in one of the headlines today. But there still needs to be more to this before we can say that we have reached the bottom. Trade speak, what is being said by the market, and how do we look at these data points today? So if we look at the softs complex as a whole, they have been strongly positive. And while we are quite clear that cocoa has been the outperformer, um, it's also the basket of commodities that matters overall, which means to say that exposure to the entire softs market would have netted you a positive earning and a positive income, no matter what. Different percentages, but for slightly risk averse marketers, an investment into a softs ETF would have definitely given you an exposure to the market with a significantly reduced rate of earning than normally. There are definitely cocoa ETFs, coffee ETFs, which can be traded. I do prefer exposure to direct futures or options because they're more actively managed. And I think typically with that, you can control your positions better, and also sort of gain better control over your stops. And also there's no lot of roll costs that come onto you. That being said, ETFs are also a pretty well-known way to gain exposure to these markets. If we look at individual performances between coffee and cocoa, we would see that Cocoa London and Cocoa New York have sort of matched each other in terms of moves. Correlation has been pretty strong, although the trade arbitrage which existed between US and London has sort of reversed, or at least significantly reduced. Um, the same thing is also happening in terms of Robusta and Arabica, where the premiums of Arabica, which is supposedly a higher quality of coffee, are getting eroded compared to a Robusta, which is catching up. And that's typically not an not a I'll say a dip on the trade, but it's also the preference of the trade to take positions on a certain variation of the same commodity. Coffee, as we know, Arabica and Robusta are used for different kind of recipes, and usually Arabicas always go at a premium. The Robusta market has been catching up quite strongly, and that's primarily because the market has been able to find ways to blend more of Robustas into your normal cup of coffee. So unless and until now you get a single origin, single flavored bean, uh, which by the way would still be expensive, most of your normal recipes, or I'll say most of the supermarket recipes, would have a higher blend of Robustas compared to Arabicas. Cotton, on the other hand, has not been impacted significantly overall, and sugar is staying high based on the performance of the markets overall, and also because fund flow has been sort of strengthening both on the oil side as well as on the production countries' performance variation side, and which is why the soft complex have been doing overall well and is expected to stay positive. Um, there are definitely chances that sugar can hit 27, once again, 27 plus. Uh, and we'll see if the trade setup sets up this week. But that's where we are. Cotton, on the other hand, can definitely turn bearish if there is any drop in demand. And currently, we do see that there is potential anytime for cotton to shift into a negative territory. Looking at what are the points of interest, the section we call as Trader Peak. So the headlines for the week: USD and stocks both jumped on strong USA jobs report. Oil, of course, posts losses over the week to week based on similar data points, where the US has decided to stay firm on US interest rates, and that means demand probably would be a little bit lesser for oil. Farmer protests, on the other hand, have spread throughout Europe. Uh, this has been an issue going on since early last year, and this is only gaining steam. Now it's spread to Belgium, German border as well. Um, Poland, on the other hand, has decided to withdraw all court cases against EU climate policy. And this is significant because this also comes in the same week that um, a climate chief has called for almost a $2.4 trillion investment in climate funding. Are these two linked? I would say so. Uh, but yeah, that's more conjecture than evidence. Um, Good news, as I said, is that the World Food Price Index has fallen to almost a 3-year low in January. Um, and that's primarily because of the fall in prices of meat and grains. But I don't think we are seeing those impacts at retail stores where the prices still remain quite elevated. The Red Sea issue continues with Houthi attacks going on. At least 25 more vessels have been diverted from the route, and that's going to make shipping towards the Middle East more expensive, more difficult, and more delays can be expected getting containers and vessels out. Upcoming reports this week, most important are the China inflation rate, UK unemployment numbers, US core inflation month on month, and the German economic sentiment. I look at Germany as sort of the indicator for entire Europe. And currently, with the situation that the German economy has been in, there is almost an expectation of recession anytime, all the time. So it's something that we need to continue monitoring both on UK and Germany. Now we go into section called Trade Educate, where we speak about this week about risk management with a smaller capital.
So, when we start looking at risk management, I suggest to look at three things: planning, placing, and performing. Planning number one is to look at the numbers in your trade, which means to say the levels at which you would enter a trade and the levels at which you would exit a trade. And why that is important and significant is that if you do not have those levels denotified in your strategy, you would typically get lost in the echo, and you would typically end up either losing the correct entry point or you would end up risking more than what you should. Basis that planning, basis that I would say even in Excel or a paper planning to say of a simple trade entry and an exit, you would then be able to understand what is the risk and the reward that you're going to look at. And that's where the concept of a stop loss and a take profit comes in. And that's also where we talk about placing.
So if we know how much you're willing to look at earning, you know the potential reward, and that determined by the movement that's allowed by the commodity that you're trading gives you the number of tick points or number of steps that the market needs to go higher or lower for you to earn that. Your take profit then, if it's on a buy side, is higher by that many ticks. If it's lower, it's a sell side, then it's lower by that many ticks. That's your take profit. On the other side, if you're buying, then your stop loss is determined by how much money and how many ticks you are willing to lose at max. And that's also the stop loss. If it's a buy side, it's lower. The sell side, it's on the higher side. Um, Placing those forms your first step to making sure that you are actually placing a trade with the risks monitored. And that brings us to the performance part of it.
Monitoring a trade is extremely important. Um, and I can tell you personal experience that there are times when I've not monitored a trade. The markets have either gapped up or gapped down, and I've lost some money, significant money, if I've not monitored those trades. Which is why we should not place a trade when we do not have the time or the ability to trade. And if we are trading, as most of us do, basis the internet, and we lose internet connectivity, um, we need to have an alternate option to reach our broker to place our cancellation orders or place our order stops to make sure that the risks are managed or even to monitor the performance of the trades. And that becomes significantly important as we go along in this trading journey.
Now we go into controversy, uh, where we talk about the tales, legends, and myths of commodity trading. And today's talk is about Ivan the Terrible. So this is an amazing story about someone the trade industry calls as Ivan the Terrible. His actual name was Mr. Ivan Boesky, and he was probably among the best known junk bond, high risk bond trader that existed in the 1980s and the 90s. And this is a story about greed. This is also a story about how the markets are manipulated, and also a story about what really happened after the person was caught and implicated in the
The
scam.
story starts in 1966, where Mr. Boesky, who had graduated from the Detroit School of Law, um, left and started working as a securities analyst in 1966 on Wall Street. Um, his father-in-law in this case was Mr. Ben Silverstein, and remember this name because Mr. Bill Silverstein was by that time a real estate magnate. Um, of course, his son-in-law was definitely a smart trader, so he invested into Mr. Boski, and Mr. Boski started then his own arbitrage firm in 1975.
Now, from 1975 to the early 1980s, Mr. Boski started working as an arbitrage specialist. And in that arbitrage specialist, he would definitely take advantage of the gap between the public market and the private market values to sort of target corporate clients. And this is basically looking at trading the securities based on prior information about certain activities that would happen in the stocks or in the corporations, um, which was not yet public knowledge. And typically, it was about acquisitions. This continued for some time, I mean, from 1975 closer to 1985, 86. He definitely
Got the eye of the SEC, which was the Securities and Exchange Commission, um, by which time he had approximately been able to make over $200 million by betting on corporate takeovers and mergers. SEC then, of course, investigated him for certain investments he made after receiving these tips from corporate insiders regarding potential targets, whether takeover targets or merger targets. And typically, he would make significant purchases, and sometimes even days before a corporation actually publicly declared it. And this kind of play definitely could not have happened without manipulation. What is interesting in this is that people inside the corporations knew of this, um, and most of them
were definitely involved in leaking this for potential financial gain. And while it has been estimated that most of the company insiders who were present in this also made a lot of money, it has never been disclosed how much that amount was expected to be and how other people's shares or interested parties' share prices moved post Mr. Boski's moves in the market. November 1986, finally, Mr. Boski pleaded guilty to one felony count of manipulating securities and agreed to cooperate with the SEC in its investigation. He actually then, just like a movie, went in and allowed the SEC to secretly tape his conversations with various insiders and um, big bond trader, um, Mr. Milken, for example, his name Michael Milken. Um, Definitely, those people definitely had to enter guilty pleas for uh,
So, as a result of his guilty plea and his agreement with the SEC, Mr. Boski received a sentence of 3.5 years in prison and $100 million fine, and of course, a permanent ban from working in the securities industry. He was, however, released just after 2 years of serving this sentence. Funnily enough, prior to 1986 and his guilty plea, Mr. Boski had given an amazing speech at the University of California, by the way, where he talked about greed being guilty, um, greed being good, sorry, greed being healthy, rather. And this was sort of immortalized in a movie called The Wall Street, of course, by Michael Douglas, where he plays the fictional character called Gordon Gekko, and where he says that greed is good, and that was prima facie talking about Mr. Ivan Boski, Ivan the Terrible. Um, and that's how sometimes the world of insider trading plays out. So um, I hope we learn something from this. Um, Greed can be good, um, but legal greed, I think, is better always than illegal greed.
Finally, we come into Tradecraft, uh, which is for the next week, and we look at the trade setups. So Coco USA, we've closed the position. It is, however, up 4.6% since last week, so great work. Final profit for me was around USD 4,300 per lot, and now we wait for the next trade. Sugar, as I said, there seems to be a trade setup coming up. So we look at buying at a break of 24.62 on the upside, with the stop loss at 22.69, but a take profit at 27.66. What I'm introducing this week also is what I call the riskometer. And the riskometer is the probability of the trade happening and also the probability of the trade uh, going in that much profit. And the color scale is something that we're going to plug in. But as we go towards the color purple, um, it is typically bearish and the probability of success is lower. And if we go towards the color bluish, typically the chances of probability of the trade being more successful is higher. And we're going to determine this over different color shades. And hopefully by next week, I would have that color scale worked out so that we can sort of focus in and showcase that on every trade setup. Um, and that sort of would give us an idea of how much risk you should place on a trade, given a trade advice. Finally, trade next for the next week. We're looking at trading deeper. We explore the world of GBP USD. We again continue our trade on risk management, see and analyze maybe a live chart, seeing how we can and manage risks and how we can manage capital um, inclusion. And finally, Tradecraft, where we try and trade some more. I hope you enjoyed this episode and that I've been able to provide you some value and add some value to your weekends. Thank you once again for tuning in. This is the Trade Stylist. The next episode goes out on the 10th of February 2024. Wish to see you there and may the trading gods be with us. Cheers.